Episode 14. There are 14 phalanges in your hands and feet. The number 14 is very bittersweet because it's typically the last day of the month by which I have to pay corporate tax, but more importantly, it's the day of the month when both my boys were born. Now, who's the greatest athlete to wear the number 14? One could say it's Pete Rose, 17-time Major League All-Star, but he still did not get a spot in the Baseball Hall of Fame because he was apparently gambling on baseball while playing for and managing the Cincinnati Reds, which does not sound like a very savvy move. Beyond MD, episode 14, here we go! Welcome everyone to episode 14 of the Beyond MD podcast. Today is Demystifying Investment Costs Part 2. Leanne Mamchur from CIBC is back to help us again today. And today's focus is more on ETFs, which I think is great because I know a lot of listeners do invest in ETFs, and I do so myself. So why do we talk about costs? Well, simply put, I think costs fall into a category of things that we can control. I know it's really tempting, and I know I spend a lot of time on this, but we typically dedicate a lot of our time and energy into predicting returns, especially when we're investing in the stock market. But the truth is, returns can be really difficult to predict. So that leads me to my point, what can we control? Well, tax efficiency can be enhanced slightly through a few considerations. So if you're investing through your corporation, if your time horizon allows it, it may make a bit more sense to focus more on capital gains and Canadian dividends, and perhaps focus a bit less on interest payments and foreign dividends, because the latter two will be taxed higher inside a corporation. So this topic was covered in detail in episode 3 with Jamie Golenbeck, and as most of you know, there's an excellent blog by the Looney Doctor covering this same topic. So that begs the question, what do you do with interest payments and foreign dividends? Well, a few of my guests have come on the pod and have very practically said, do not let the tax tail wag the investment dog. And I think that's very sound practical advice. But if you're interested in enhancing things a bit further, what you could consider doing is holding interest payments and foreign dividends in vehicles like RRSPs or pension plans. And RRSPs for small business owners were covered in episode 7, and pension plans were covered in episodes 9 and 10, so feel free to check it out if these situations apply to you. Alright, so what else can we control? That brings me to cost. You know and I know that higher costs over time are going to eat into returns. So it makes sense to control costs and lower costs where we can, but we can only do so if we understand how they work and where to find this information. So that's the focus for today. Now, before I get into the interview, I need to discuss a personal investment decision because I think there are some learning points. Now, for this discussion, I'm not able to name specific stocks or ETF tickers, so I'm going to keep the discussion generic, but all details can be found on my latest blog post at beyondmdpodcast.com. Check it out. I think there are some learning points here. So anyways, let's go back to 2018, which is when I started to invest. When the market correction started in October 2018, that's when I started to pick individual stocks and ETFs. And the first ETF I bought came with a management expense ratio of 0.56. I know what you're thinking, that's kind of high. Anyways, I put my money in and my friend said the same thing. 0.56 is not insignificant. What is the value added here? At the time, I just shrugged my shoulders and I said, well, time will tell. So anyways, I recently went back to do my once per quarter portfolio checkup, and to my very pleasant surprise, since October 2018, this ETF has dramatically outpaced peer ETFs in the same sector, and to my very pleasant surprise, it's actually outpaced most of the stocks in this sector. So then I went back to the ETF fact sheet, and lo and behold, at the bottom of the third page, there is a TER, a trading expense ratio as well, albeit very small, 0.02%, because there's an active or rebalancing component to this ETF. Now this brings me to 2 points. Point number 1, know what you're investing in. If you were anything like me before, I would simply look at the ETF fact sheet front cover, look at the ticker, the asset allocation, the risk profile, and then just chuck it in the garbage. But had I been more astute, I would have gone to the end of the fact sheet and noticed that this ETF, because of its active rebalancing component, has a TER, a trading expense ratio. And to get the total cost of the ETF, you have to add the TER to the MER on the front page. Now realize most ETFs are not going to have a trading expense ratio, and those that do, it's going to be very, very small, minimal to nothing. But it pays to be informed. Point number 2, Just because an investment decision has a somewhat higher management fee associated with it does not always mean that this investment is a bad decision. Now, trust me when I say this, I am an advocate for low costs and reducing costs wherever possible, but sometimes it can take a bit more time to figure out if there truly is value added with a slightly higher fee. So check it out, beyondmdpodcast.com, food for thought. So for today's interview, Leanne Mamchur from CIBC is back, and if you did not hear her intro in the previous episode, here is some information on Leanne. So Leanne Mamchur is a portfolio manager with CIBC Private Wealth and has over 19 years of experience in advocating for private clients. So she graduated with distinction from the University of Alberta and continued by obtaining her Certified Financial Planning designation, the Financial Management Advisor designation, as well as the Chartered Financial Analyst CFA Charter designation. She's held various roles throughout her career, including personal banking, investment advisor, investment counselor, as well as her current role, which is her most satisfying role as a portfolio manager. She's originally from Saskatchewan, currently lives in Calgary, is married, and has 2 toddler daughters. Here's my interview with Leanne Mamchur. All right, Leanne, welcome back for round 2. Thank you for joining me again today.
Thanks for having me. And yes, round 2, right?
Yeah, so I think we got through most of the jargon in round 1, which is great. And today we're going to be focusing on ETFs, obviously, which is awesome because I know there are a lot of DIY investors listening to the pod who do this. So anyways, but I just want to get your sense of kind of what you've been seeing in the industry, because I recently read an article in the Globe and Mail that was talking about mutual funds making the comeback and a lot of money going into them. But I would assume during COVID that, you know, depending on your situation, maybe you've saved more, maybe people have a bit more money to invest. So I would think that all around ETFs as well, there's probably a lot more money going into those. I'm just wondering, like, what are you seeing in terms of what's happening in the industry? Any rough trends going on?
Yeah, and I think that honestly, like with any time that the market is performing fairly well, which has been the last little bit, it has been, generating some decent returns. So you do see fund flows both towards mutual funds as well as exchange traded funds increasing during times of that the market is improving, right? And so that's just natural behavior, I suppose. And so, but yeah, no, I definitely think that people have a lot of idle cash right now as well, right? And so they're looking at locations and where to place it. They're not able to do their traveling as normal. And so then sometimes the investments, whether it be mutual funds, ETF, or separately managed accounts or individual equities, like they are getting the benefit of the excess savings.
All right, so I was looking at an ETF fact sheet for an ETF that I like to follow. And when I go to the first page, I see 2 sets of fees. And to keep things simple, I'm not going to name anything right now. So the first fee that I see is the MER, the management expense ratio. And I think in this case, it was about 0.22%. But then right beside it, there's a management fee of 0.20%. So Leanne, maybe you could just tell us what we need to kind of take home here, because my understanding is that those fees are not really separate. Like the MER should include the management fee, but perhaps just tell us what we need to understand here.
The management expense ratio does include the management costs. And so where you're looking on the fund or the ETF facts, it breaks it down for you, but that's included inside of the management expense ratio. So you don't need to, it's not additive.
All right, perfect. So maybe let's move on to the trading expense ratio now. And I know there's so many ETFs out there, and many of which are passively managed, but then I think there are going to be some that have a bit of an active component, maybe a rebalancing component. And so there's going to be a TER there, a trading expense ratio. But my question is, Leanne, can you just tell us with regards to the trading expense ratio and ETFs, what do we need to know there? And then is this type of information always readily going to be available to us?
Yeah, and so then you can also find the ETF fact sheet is similar to the fund fact sheet on the mutual fund side. So you can see some of this disclosed on that sheet. But this is only to do with Canadian ETFs, and you won't get this type of disclosure in other countries, right? And so the trading expense ratio, you will have for certain exchange trade funds, you will have this component also additive. And so it would be the management expense ratio plus the trading expense ratio. But it really depends, you're not wrong, as to what the underlying securities are of that exchange traded fund to determine like what if it's more actively managed, and not dissimilar to the mutual fund side where there's thousands upon thousands of mutual fund varieties. There's also thousands upon thousands of ETF varieties as well, right? And so, yeah.
Okay, that's really, really helpful. Now, maybe let's move on to the bid-ask spread. And I'll just ask you open-ended right away. What is the bid-ask spread? And maybe just tell us a little bit about how it works.
And so then basically the bid-ask spread, an exchange traded fund, dissimilar to a mutual fund, is actually traded on the market, right? And so you could buy an exchange traded fund at any moment during when the market is open. And so, and that would be the market that you're currently dealing with and the market that you're operating within. And so, but the buyer of an exchange traded fund will have to pay one price, and the seller will receive a different price, right? And so then the difference between those two, that's what's referred to as the spread. And so there's an incremental difference. Like if you were to buy and sell on the exact same time, exact same moment, you would be out money, and that would be the spread, if that makes sense. And so yeah. And so the market makers in an exchange traded fund tend to try to keep that spread quite tight because it is based on an underlying basket of securities. So there's arbitrage that you could do as a market maker to kind of create that spread that would be tighter. But it's an extra cost to trading in an exchange traded fund that you do need to factor in.
All right. And I just want to establish maybe a few take-home points so that we can all kind of understand when having knowledge of the bid-ask spread actually becomes helpful. Because for me, one thing is when I'm buying an ETF, I will now tend to do that by buying it by placing a limit order. And that's because of the bid-ask spread. And we all know that there are going to be certain days of the year or maybe even certain times of the day when there's going to be some heightened volatility, and then that spread may widen. So maybe something to keep in mind. But Leanne, maybe you can just kind of guide us and help us understand a little bit more as to when does having knowledge of the bid-ask spread become more important when you're investing in ETFs?
Yeah, for sure. And so I think that to back up just a little bit on your question as far as when I would be purchasing an exchange traded fund or what have you. So institutionally, we have exchange traded funds and trading desks and things like that you have a see-through in the bid-ask spread, and they have like better knowledge, and so they can assist portfolio managers like myself in kind of doing or executing that trade. So I think that that's as a backdrop as to like I would call as far as for advice for larger trades and what have you, right? And so, but in general, I think that for a do-it-yourself investor, you're not wrong in the sense of the limit orders. And so then I think that that's a good way to go with exchange traded funds because there can be anomalies, not only to do with the bid-ask spread, but also just pricing anomalies and just interesting things in the market when volatility increases too much, and not even trading volumes, but more so the volatility, I would say, of the underlying pricing, and there can be room for arbitrage and things like that. So then, like, there's nuances that you kind of should be aware of, and I would say another one besides doing the limit order would be on knowing if the underlying market is having a holiday whereby, like, let's say if it's not a holiday here in Canada, so the Canadian market is open, so I can buy certain exchange traded funds, but the underlying market, let's say in the US, is closed, then you could see a little bit of discrepancies in your bid-ask spread. So you just want to be aware of those types of things. If not necessary, I would say that maybe avoiding those days if you don't have the ability to call a trading desk, right, like us, right? And so
Okay, so some really helpful considerations there. I appreciate that. But I guess in the grand scheme of things, Leanne, like my hunch is that the bid-ask spread is going to have less an impact on our overall cost than compared to the MER, right? So I guess I'm not going to go to bed tonight worrying about the bid-ask spread eating into my returns.
no. And I would say, and an add to that, and so sometimes with ETFs, it's very easy to trade in and out. You just want to be aware that the more you trade, the more bid-ask spread that you're exposed to. So with a buy and hold strategy, you're not wrong, is that the bid-ask spread becomes a very minor point. Whereas if you like to play around and trade a bunch, then it can become a little bit higher of a concern for yours.
Yeah, I think that's a really good point. Now, one thing I do want to get into is the swap-based ETFs. And I'll start off by just asking you to tell us what a swap-based ETF is. And then maybe we can talk about some of the advantages. I understand that it can be a way to enhance tax efficiency, maybe work around some of the passive income rules. And I also understand, though, there may be some cons. So sometimes these ETFs could be associated with a higher MER, perhaps. But maybe just walk us through it and tell us about some of the pros and cons.
Sure. And typically, because I'm running with institutional money managers myself, is that when I'm using exchange traded funds, they would be passively oriented, right? And so then it would be because I want exposure to a specific market that's efficiently traded, that type of thing, right? And so then with an exchange traded fund, there's both exchange traded funds that are based on the physical assets. And so then underlying it, they're holding a basket of actual securities, right?
Yep.
And then there's a different one, like you've mentioned, which is the swap-based ETFs, whereby the underlying offer, like the issuer, I guess, would be going into an arrangement whereby they enter a swap trade. And I know that's but basically what they're doing is they're trading some, cash return or something like that for the total return of a particular market. And so they, in essence, are receiving the total return, but by use of this swap arrangement. And so there is a cost because the swap itself is a market security, right? Or a market instrument. And so there is the cost of the swap. But the advantage that I see there in particular is when it comes to, some of the rules that have changed for passive income. And so receiving dividends or receiving interest for a corporation is less, like some people want to preserve their small business, taxation. And so then so passive income is important. And so then with the swap type ETF, you can actually have the total return just added to the ending price that you sell it at. So there's no in between dividends or interest or things like that that are attributed or added to your passive income. So anyways, I know we're getting into the weeds here, but basically there's ways by use of exchange traded funds to try to solve or look at that passive income issue, or even with high net worth clients that want not that, or just to defer. It's kind of like a tax deferral, I would say.
Okay, that's pretty interesting. So what I'm getting here is that with a swap-based ETF, you're not going to be getting dividend income. You're going to bypass that or defer that. And whatever gains you get is basically they're going to translate into a higher price for that ETF. So I guess a good way to kind of work around passive income rules if you're investing through the corporation. But one thing I do want to clarify is you did mention the swap cost. So there is a cost associated with it. And I'm just wondering, how is this going to show up? Is this typically going to manifest through a higher MER? Is that something we need to look out for with these ETFs, or is the cost going to come in some other way? Maybe you can just clarify that.
And so typically you won't see an adjustment to the management expense ratio, but right directly on the ETF facts sheet, you will see a potential total charge for the swap arrangement. And so sometimes a Canadian basket might not have, there's certain tax rules that kind of like prevent or like work around that. So you might not have that additive swap cost associated with it, and different markets will have a different swap costing, right? And they're just going to give you an approximate because it's done through capital markets at various institutions. And so you also want to have a lens on who is the counterparty of that swap and what the risk is there, which I think for the most part that I've seen is fairly limited. And so as far as the risk.
Okay, that is good to know. And then I guess my last question is, with respect to using a swap ETF to enhance tax efficiency and maybe work around the passive income rules, is this possible with essentially all swap-based ETFs or only certain ones?
That is a really good question, because I know I just finished talking a great deal about swap-based ETFs, and likely it very much sounded that it was the swap-based ETF that created the tax deferral ability. But I should have specified that it is actually the use of a corporate class structure and its ability to offset against losses that creates this tax advantage. So the swap-based ETFs are just more prevalently used by the firms that are offering the corporate class structure, but it is in fact the structure itself that creates the ability. The swap is just kind of a tidy way of managing the ETFs and a total return basis, which makes it a little bit easier in this arrangement. And therefore, for this reason, it is primarily found within these corporate class structures and for the purpose of the passive income. So I know I'm getting into the weeds here, but another thing to note would be that prior to a change in the federal budget in 2019, the swap-based ETF could actually enjoy this tax efficiency without the use of a corporate structure. However, this is really no longer the case. So I would say, in essence, this is a really great example of where an investor really needs to know the fine details, including any changes that are made along the way and any of the details. And to create that best strategy, it requires a lot of digging. Or I guess for my advice is to, if they would prefer in this specific area, they could simply rely on the expert advice of somebody like myself to help them navigate this area. But, I know that your audience is do it yourself. And so, but it would require a significant amount of digging, I guess.
Yeah, I think a large number of people are DIY, but not everybody. But I think it's really nice that we talked about this, because I think, let's just make it a take-home point that you can't just pick any old swap-based ETF and expect it to offer the advantages that we've been talking about allowing one to kind of circumvent the passive income rule. So bottom line, we need to do our digging or get our advisor to do it. And perfect example of how knowing the fine print can be helpful and not knowing it can be costly, potentially so. All right, guys, back to the interview in just a moment. Just want to thank everyone for tuning in again, and special thank you to those of you who took time to give me some feedback. The most interesting piece of feedback I received after the last episode was from Mark, who questioned my judgment because I said that Matt Sundin might be the greatest hockey player ever to wear the number 13, and I picked him over Pavel Datsyuk. But you know what, guys? It's a coin toss. But if you want to get a hold of me, please do anytime, beyondmdpodcast@gmail.com, or hit me up on LinkedIn if you want to give me topic suggestions, or if you just want to talk some trash. Whatever it is, I am down anytime. But for now, back to the interview. All right, Leanne, so moving on from ETFs now, let's shift gears a little bit. Let's go into robo-advisors. And I will say straight up, I do enjoy robo-advisors because of the automation. I know that every month I have some money that's going into my investments. And this approach works for me because I know that if the markets are dipping, I'll want to buy more, but I'll try to time it. And if the markets are going up really quickly, then I'm keeping an eye on them. I'm probably doing some investing, although I'm not as keen to do it. So the automation just kind of takes all that guesswork out of play, and it just ensures that I'm staying invested and kind of sticking to my plan. So for me, that works. But obviously, we know that robo-advisors come with layers of fees. So maybe I'll just get you to open-ended, just discuss the different layers of fees that we will experience when investing with a robo-advisor.
Yeah, sure. And yeah, robo-advisors, definitely the ease of like a couple of clicks, you can just have a portfolio and it's ready at your fingertips and that type of thing. That is part of, especially with the whole COVID thing, that is part of the attraction, I would say. And also potentially on the appearance of cost savings for some, right? And so I would say that the levels of fees that you need to be aware of with a robo-advisor when you're working with them would be their overlay. And in the industry, when I was looking at this, there's typically a cost overlay of about 0.2% all the way up to 0.7, but on average, probably around 0.5, let's call it, right? And so that's for the use of their software and them putting together the portfolio and then providing the system in itself, right? And so that's kind of what what they're doing for you there. But in addition to that, then you have to look at what the management expense ratio is of the underlying instruments that they're putting into your portfolio. And so just because I knew I was going to be doing this and also researching for my book is basically I went to a robo-advisor and kind of put together a portfolio myself. And the management expense ratios range from 0.03% for a broad market like US, all the way up to 0.68% for an emerging market. So, but the overall portfolio as a whole resulted in about 0.25% to 0.3%. So then when you add those two components together, now you're sitting at about, let's say 0.75 or 0.8% as far as a cost side. And then, over and above the management expense ratio, then you have to consider those other factors. But you're getting into the range of having a full advice, especially, typically, my typical size portfolio is around 5 million. And so, but having said that, typically clients about 2 million and above start to get into this range of that all of a sudden these types of solutions aren't in fact cheaper, but then you don't end up getting the advice piece, right? And so and so then it depends on the kind of client that would be best served for this platform, right? And so.
All right, so to reach my next point, I'll tell a quick story. So I started investing in summer of 2018, and I started with a robo-advisor. And at the time, I had really no idea what the costs were going to be, apart from the cost for using the platform, which was in the range of 0.4 to 0.5%. But as you mentioned, there are layers of fees. So you have the fee for using the service, the platform, but then you have to add on the MER for whatever products you're investing in. So you've quoted some numbers there which are totally accurate. So depending on what you're investing in, you can get up to 0.8%, let's say. And listen, I'm not here to hate on robo-advisors. I'm always going to use them. I, in fact, like them because of that automation feature that I talked about. But 0.8%, someone can say, okay, that's not insignificant. Like you're closing in on 1%. Why not pay a little bit more and get some advice? So that's one side of the coin. And I'll maybe present that to you. Like, how do you reconcile that statement? What are the considerations that people need to keep in mind?
Personally, I know you're a fan, but personally, I do think that there's a lot of advantages to having that advice in your back pocket, especially even if you are just starting out and have less than 1 million or 2 million or what have you. And so then, should you pay down a mortgage faster than a TF, or contribute towards a TFSA, those types of things, that's the missing component with the robo-advisor platform, right? And so, yes, it does give you mix. It does give you that automation that you're talking about. But I'm not sure, price-wise, if you think of 0.8, let's say, versus a typical retail mutual fund, the retail mutual funds have come down quite a bit in pricing. So you're maybe looking at 1.2, 1.6%. And so then what differential would you be looking at? And what are you giving up as far as not having that advice, even in the retail, the retail space or people that are starting out, right? But, I'm very biased in this area, I have to admit. And so.
All right, I appreciate your candid answer there. And now let's look at maybe the other side of the coin. And people are going to think oh man, he's really hating on robo-advisors, but I'm not. Regardless of what is said here, I'm going to continue to use them for a small portion of my portfolio because I like things to be automatic. But the other side of the coin, okay, if you're going to pay up to 0.8%, and it's not always going to be that high, but then someone could present the counter argument and just say, hey, just do it yourself. Buy ETFs. You can buy a globally diversified ETF with an MER of 0.2, 0.25%, or just buy individual stocks and just pay a small commission on that, and you'll be saving on costs. So that's, I guess, another consideration, right? You just do it yourself and save on further costs.
Yeah, and certainly but what a lot of people don't consider when they're going about doing it themselves is that they don't factor in their own time, right? Because I would say that, cheaper is it dependent as to what you're factoring in and what you're not factoring in? Because there's always a trade-off. Like, do you spend less time with the family in order to do this type of investing? And maybe that's your trade-off and you're comfortable with that. But I would say that you need to put an hourly cost associated with your own time if you're going to compare apples to apples, honestly. And so then, so yes, technically the answer is yes on a dollar sense, but that's not factoring in your own time, I guess.
Yeah, so a note on time. So on one of my earlier episodes, I think it was episode 5, I actually interviewed a portfolio manager and I told him, like, hey, listen, you know what? If I'm ready to spend 2 to 3 hours a week, pick my own stocks, I should be able to hit a few home runs, right? And he kind of just looked at me and he was just like, are you kidding me? He's like, I do this 60 hours a week. It is way harder than you think. So I think your point on consider how much time you have to spend is well taken, particularly if you're going to be picking your own stocks. So
yeah, and I think that particular person, it's honestly, and even it's an institutional money manager. Each segment has a whole team underneath them of analysts, right? And so then there's probably 80, 100 plus individuals putting together any sort of individual portfolio, and that's really hard to replicate on an individual basis. Yeah,
totally. Time is money, right?
for sure.
All right, so Leanne, I think we'll wrap up by just talking about some proposals for alternative cost structures, because I know this is an area of interest for you, something that you're quite passionate about. So I'll just kind of open the mic to hear some discussion on this. And I think the model that we, just to start off with, that we are most kind of familiar with is, being charged a percentage of assets under management. But I'd just like to hear your thoughts on some other viable cost structures.
Yeah, and for me, I actually was very fortunate about a year ago to have the ability to kind of take a step back from the industry and having worked in it for over 19 years now, right? And so taking a step back and giving it some thought as to what do I think cost structure wise should exist as opposed to what does exist, right? And so maybe earlier in my career, I would have just, it is what it is and just moved on. But now I've kind of had that ability to take a look and decide, what should exist. And so this is all going to be just opinion based, and that's for sure. And everybody's doing it different ways and for different reasons. But as far as what I feel is though that maybe we could evolve towards would be more so along the lines of a flat cost structure for the front end in particular, as far as the service and the advice pieces. Because in my practice, what I've done is I've based it on what the client wants from a service perspective. And then from so say for instance, do they want one meeting? Do they want two meetings? Do they want family foundation, family trust, corporations? So then all of that is factored in as far as from a time perspective as to what that looks like. And then an estimation on cost is determined and that flat cost is struck. And so say for instance, if a client has 5 million invested right now and receives an inheritance of 2 million extra, in the typical percentage basis, yes, the percentage would be dropping, but technically the dollar amount is increasing, right? And so technically you're charging the same client more money just because they received an inheritance or because they're successful and that stopped. I guess it stopped resonating with me because it just didn't really kind of make sense to I guess it's somewhat of a penalty on wealth, and it's also a penalty on simplicity. And so some clients are, they might have $10 million, but they're not complex. They don't have a lot of complexity. And frankly, having talked about complexity, that is a matter of experience. And so depending as to the advisor's experience, it may look more complex than others, right? And so, but in essence, I would say that a consideration of a flat cost arrangement might serve clients well in the sense of then as they continue to grow, as they continue to add to their assets, then you're not consistently charging more and more and more, right? And so, but having said that, one thing to note is that if you have 200,000 or 500,000 and you price out service, it might actually turn out to be much higher, too much of a percentage. So it really, it kind of makes sense for clients in my arena as far as private clients.
Yeah, I think what you're saying will resonate with some people because when I look at percentage of assets under management, I think that in some cases, over time, it can be a bit of an unfair penalty on somebody who's building wealth over time. The portfolio is getting larger. And when in fact, over time, this individual may in fact be lower maintenance because a relationship has been built and a lot of the more difficult legwork has already been done. So I think that's something to consider there. And then I'm just wondering, in terms of other cost structures, I've heard of something, and this was through a robo-advisor. So here we go again with robo-advisors, but a monthly flat fee. And then I've also heard about somebody talk about a loyalty discount. So basically, after a certain number of years have passed, a relationship has been established, then that individual would get kind of a discount on the cost. So I'm wondering if you've heard of that or if you've heard of any of these other structures.
Yeah, well, and I'm not sure on whether there is that loyalty discount, but I can say from experience that as trust is developed with an advisor and you have a longer period of time together, you need fewer and fewer services because you know them and you trust them. And so then likely, like with loyalty as an example, I can say that the clients that have been dealing with me for years, they are less in the way, as you point out, maintenance, right? And so because they know me already. The structures are all there. We have all of it established. And so thereby the pricing should be less, right? If you think about it in that way. So it's not dissimilar to a loyalty, kind of thing. But if you price based on service, then as the service tails off, the pricing naturally will tail off. But I'm not aware of, firms in particular, but I just haven't come across it, I suppose. Like there probably is that. So the monthly flat cost structure. So the other thing, and you didn't ask this, but I'll bring it up anyways. But the other thing that I considered was kind of like an hourly basis, right? And so the flat cost that I have is technically based on an hourly calculation, but it's forward thinking, right? And so it's an estimate, as opposed to billing on a per hour basis. Because I know that sometimes clients just need that conversation, and you don't necessarily. I would hate to be deterring clients from having that conversation because they know they're on the clock. And so then there's that part of it. And so then I think the flat monthly is not dissimilar to having kind of like a flat overall cost structure. And so there's lots of ways of splitting it. But you're right. Some cost structures, like the hourly, as I was saying, might create a little bit of a disincentive for clients to ask good questions, and so to engage a client or engage an advisor.
Yeah, I hear you. And like I said, I just don't think there's a single cost structure out there that's perfect. But it's nice to talk to somebody like yourself who's really open-minded to this and who's giving it a lot of thought. And so let's just say if one has an advisor, is it just safe to say it's okay to have these conversations with your advisor to maybe find a cost structure that works well for both parties? Like, is this a situation where if you don't ask, you don't get?
Well, I think that consumers and clients will drive a lot of behavior and can create industry change, right? If they're vocal enough about it, right? And so I do think, and I do encourage, because I think that other advisors would adopt this type of mentality and this structure. They need to be partnering with a kind of an innovative firm that kind of adopts this type of a strategy and embraces it. Having said that, I think that exists if you're creative, right? And so you can absolutely do that. And so then I think that as more consumers are asking or more clients are asking for these types of arrangements, I think advisors will need to step up and listen potentially. Like everybody runs their practice differently, as I had mentioned, but potentially it could be something that it never crossed their mind or never thought about. Because as I said, before I took the step back from the industry, it's not something that crossed my mind, honestly. And so, because sometimes it is what it is and you just accept it, and then you get this little break and you have the ability to kind of think about it a little bit more, right?
Yeah, it's amazing sometimes how if you take a step back and just reflect on things, it can really result in some positive and constructive thinking. So honestly, it's great to see. And Leanne, I just want to thank you again for spending time with me today. I really enjoyed talking to you, and you've given us a lot of good content, a lot of good things to think about, and it's been a pleasure chatting with you.
Well, thank you very much again for having me, and hopefully it drives some more conversations and some more dialogue for sure. And so, thank you.
All right, take care, Leanne.
Take care.
All right, guys, that's it for today. I hope the content was helpful. So remember, costs are important because we have some control over this, and costs can impact our long-term returns. So if you guys like what you're hearing, feel free to download, subscribe, and spread the word. I'm always really appreciative of any reviews, ratings, and topic suggestions. So again, reach out to me anytime, beyondmdpodcast@gmail.com or on LinkedIn. We'll see you again in about 3 weeks. Until next time, stay well, and thanks again for listening.